let's go ahead and get started. Welcome to Simple Steps to Planning Your Transition. We are now on week 4, and our series objectives are to help you as a business owner understand the integrated transition planning process, to learn the importance of your transition planning team. In other words, you don't have to do it alone. There are a team of people that can come alongside you and around you to help you make the right decisions for you and your company. And then to be able to walk away with some free tools and resources. Earlier in the month, we were joined by Melissa Johnston, who talked about banking, Justin Erickson and John Bennett in community impact. And then last week we had Josh Bobich, who joined us for our legal team. And we have a number of free offers that we're going to give you today from those partners. And today we're very excited to be able to talk with you a little bit about your business brokering. And that brings us to week 4. And with that, I would love to introduce our senior transition planning expert, Ms. Laura Moen.
Thank you, Brittany. Brittany is our marketing and product development person at VisionOne, and thanks to her talents, she makes us look good in events like this. Brittany mentioned I'm the Senior Transition Planning Advisor for VisionOne. I'm also a Certified Exit Planning Advisor. But what I'm not most proud of, but what I like to say is I'm also a former trophy wife. And that's because I'm a recently exited owner. I sold my trophy and awards business that was located up in Brooklyn Park, closed on that in May of 2019. And it was an interesting journey getting there because I was a corporate refugee, as I'm told. I was in radio and advertising for 25 years, and in 2003, bought the company Viking Trophies, which you may be familiar with in the Twin Cities. Bought it from the original owner because that owner did not have family that wanted to take it on. He was done with owning the business, had founded it in '69, and I was ready to recreate myself, and I became a business owner and a trophy wife. And I bought that business as a financial investment. I bought it as a lifestyle job, as a job. I knew I would sell it at some point in time. I bought it with the assistance of a business broker, somebody else in the Sunbelt business office at that time. And I knew I would sell it, and I worked in that business for 10, 12 years, and then I realized if I wanted to transition from this business, I needed to start working on it. I needed to start creating its value, having it be able to stand on its own so it would attract a buyer, and that I could transition out of it. And I also I realized I needed my next chapter. Because as a business owner, when you transition out of your business, and you will transition out of your business, it's a guarantee. You will either do it vertically with a plan, you're directing it, or you will do it horizontally. But I needed to have my next chapter. And that's what I'm doing now, is walking alongside business owners, working with them to learn about transition planning and to bring it into the present tense. Because if you look at the idea of transition planning from the VisionOne perspective, it's almost like an umbrella. You know, it's an overall process, and there's really 3 phases to it. And it doesn't happen overnight. It is something that we want you to bring into the present tense, bring into the day-to-day now. Because part of it is growing the value of your company, value growth work. The value of your company is not just on your P&L, it's on a lot of intangible assets. And Ray will talk a lot about those today. And you want to devote time to growing that value. Because while it grows in value, you as the business owner get to reap those benefits. And then there's the succession planning. You know, what is your vision? What is your vision for yourself? Is it a next gen succession transition? Is it an internal manager? I ended up selling my company to the then general manager. And we took time, 2 years, 2+ years, where I was out of the day-to-day. He was working it and running it day to day and learning it so we could transition it. And then there's your exit strategy, your own personal objectives. What are you going to do? You could say you're going to retire, and that's viable, but what does that look like? Because you have been getting up every day running this business, and what's going to keep you going? So that's where transition planning is really a 3-phase process, and it's also an ever-changing, ever-moving process. And where we're coming to today is what we see as step 2. Your first step is really identifying your goals. You know, the decisions you're making now affect your transition. So start with the end in mind, set those goals, and then form a team. Again, you are the expert in running your business. So bring alongside you other experts that can help make your transition successful. And that's who we're introducing you to over these 6 weeks, are different people to sit at the table with you as you work on your transition. Because from there, you will learn and identify the different types of buyers or investor types. You will understand the market value of your company and how you can increase that value, and what are those drivers that increase that value. And working on the qualitative and quantitative elements of your business. And this is a process that you repeat. It's a business strategy. That's really all it is. But you're asking yourself, am I ready to grow or exit? Now, the dynamics of the world today with a lot of business baby boomers, you've got 10 million of us that own businesses. And it's a timing factor. As we age, we will want to transition to our next step. Well, there's roughly 10 million of us, and 8 million of us don't have a plan. We don't have a plan for what our exit or transition will look like, which is unfortunate because, again, it's a business strategy. And if you don't have a plan and you attempt to go to market over the next 10 to 20 years, you're not ready. Your business isn't ready. You might not be ready. And as you try to transition, there's a highly likelihood of that transition not happening. Your business is rejected. Your baby that you think is beautiful, and it isn't as beautiful to the market as you think it might be. And that transaction doesn't happen. It doesn't close. Or if it does close, there's not a successful integration, and you may still have some skin in the game. You may still have some seller financing on the table. And if it's not integrated well, that can be a problem. So there really are some steps to planning your transition. And again, we're here to walk alongside you and to help you learn those steps and embrace them into the present tense, and realize you don't have to do it alone. But it's really about starting early and understanding it. So oftentimes as business owners, we think transition planning, exit planning, oh, that's something way in the future. You know, that's not until right before I retire. Well, that's one way of having that mindset. However, you can end up leaving some value on the table. You can end up not having that liquidity event be as big as you'd like it to be, because you are waiting to plan that transition. And maybe you're not diversifying your wealth. You don't have an overall vision for yourself, for your business. And you don't have a written plan that is aligned with your mission, vision, and values.
All right, I think Lori may have frozen there for a little bit. What she was going to say was that really that advisory team is like a 3-legged stool. And so they provide the expertise and the support that you need so that your finances, your business, and that personal exit like Lori was talking about are in balance. And those are actually the experts that we have brought together. So today we have Ray Carter with Sunbelt, who is talking a little bit about your value range. It's important that you understand that. Your attorney, your accountant, your CPA tax advisor, that personal finance advisor, other consultants like VisionOne, a business banker, and of course, insurance. Lori?
And I'm back. I had a power outage, a little power surge, and thank you for stepping in, Brittany.
Yes.
Brittany will be working the chat box for Ray and I, so please, as you have questions, don't hesitate to write your questions in. But what are the top 3 problems? We're interested in one, that you anticipate in your own transition planning process. Ray and I have points we want to get across that we feel passionate about. But what questions do you have? And those are the things we want to make sure that at the end of our time together, we've addressed. So please type them into the chat box as they come up and we will address them. But at this point, I am excited to introduce to you a fellow CEPA, a fellow certified exit planning advisor, and an extremely great resource for us at VisionOne for knowledge, for information, for insight into the business broker world. But welcome, Ray Carter from Sunbelt Midwest. And Ray, you'll want to unmute yourself.
Ray, I think you're still on mute.
Can you hear me now?
There you go.
Absolutely. Welcome and good morning.
Yeah, all right. Sorry about that. Lori, thanks for that great introduction. Good morning, everyone. It's a pleasure to be here to speak with you. Just to go a little bit more over my bio, I am a M&A advisor at Sunbelt Midwest. We are a buy-side and sell-side advisory firm that serves lower middle market businesses. We're headquartered in Minneapolis, and we have a staff of 70 advisors, analysts, and business development representatives. We are part of the larger Sunbelt franchise that has about 200 offices worldwide, and we are involved in transaction size up to 100 million in revenue. I've been with Sunbelt about 15 years and have been involved in more than 100 transactions. Before Sunbelt, I was a finance and accounting leader and executive for 3 different Fortune 100 companies, covering aerospace and defense, controls, HVAC, business process, and IT outsourcing. And over those years, have been involved in a number of turnaround profit improvement initiatives. The first slide I want to talk about today is I don't see the slide. Brittany, is that up? There you go. It's sad to hear that over 80% of business owners do not reap enough from their transition of their company to meet their goals. Perhaps the proper alignment and management practices in place would fix this. In this slide, we share at a high level a composite of what we have learned about the practices of business owners that have successfully transitioned their companies. First, they view a business as a financial asset. Recently, when responding to an offer, I had a client say in a disappointing way, that buyer is looking at this as an investment. The sellers, husband and wife, started a business many years ago, and they both worked in the business, and it was a lifestyle for them. However, the market and most buyers look at a business as an investment in a financial asset that must have an adequate return to meet their goals, just like bonds and stocks of a publicly traded companies. Business owners who successfully transition their company understand this, and the majority owner of shares, they focus on maximizing shareholders and stakeholders' total returns. This focus helps to not only ensure sustainability of the company, it also facilitates achieving a great price when it comes time to transition the company to new owners. These owners, like leaders in publicly traded companies, practice value-based management. They always have a good feel for the value of their company and how the market values their business. What drives value up, called value drivers. What drives value down, referred to as value deflators. This enables them to determine how each business decision affects long-term company value. It is extremely important for business owners to understand how the market values their company to avoid running toward a cliff they cannot see coming. I recently met with a seller who was looking to sell her company and retire. She thought her company was worth about $3.5 million and thought she would sell the business and have a nice retirement. We looked at that business and did a valuation, and at best, it was worth about $600,000. Quite a big of difference. And by the time she sold the debt at closing and paid taxes, she could not live the life she wanted to after retirement. So that's critical to make sure you understand the value of your business. Also important from day one, the successful companies manage the business as if it's for sale, even though it is not. And that's important to do. And they do this starting with a 5-year actionable business plan that is a roadmap of how the company will meet their goals over the next 5 years. So that plan determines what the valuation goal they need to meet their lifetime goals, what the financial performance needed by year to meet those goals, what markets and customers to serve, and importantly, what technology will be employed to deliver products, services, etc. Now, I can't begin to tell you how powerful that is when you have a meeting with a buyer. And one of the first questions most buyers ask, are there any growth opportunities? And unfortunately, many sellers say, yes, I just need to add a couple of regional salespeople and things will get better. And I have to tell you, that falls upon deaf ears. Versus if you can demonstrate that you have a business plan, actionable business plan, that you're showing progress against, and it's a roadmap of how you're going to look in 5 years, that's powerful in terms of supporting your market valuation. In fact, private equity groups generally will not buy or invest in middle market companies without first developing an exit plan. But also, if you look at selling a business, selling price is important, but the name of the game is really net proceeds. When you sell the business, you recognize that's a taxable event because there'll be a gain you have to recognize for the government, and it's important to plan, have a tax strategy planned out how to minimize your tax liability. Also, you will have to clear all your long-term debt at the closing table. So that's important from your planning standpoint. If you max out and sell at $5 million and you still got to pay $1 million in taxes and $2 million in debt, that's a big difference. So you have to manage that. I had an owner not too long ago sign an engagement agreement to sell his business, and then he found out the hard way, as he just had invested $1 million in new equipment because he thought it was additive to debt that had to be settled at closing. And unfortunately, that's not true. It's one or the other. You value a business based on the business value based on cash flow, or you value based on assets. And assets depreciate fast, and tend to always be less than the value based on your business performance. Some building blocks. These companies have put in the building blocks for success. Uh, Risk management, they try to avoid some of the value deflators like customer concentration, we can talk about later. Also, they make sure they're not owner-centric, which is also a value deflator. Uh, Performance measures and accountabilities, very important to get these right. And unfortunately, most companies in the United States have a hard time coming up with the right performance measurements. They get the appropriate alignment to the company to meet their goals. I learned this when I was at Honeywell in the turnaround team of one of their large divisions, that we were missing our P&L numbers, but the production organization was maxing out on their bonus. The sales people were maxing out on their bonuses, and the engineering people were design people were maxing out on their bonus, but we were missing the proper objectives. So we had to go back and revamp the measurement system to make sure we got perfect alignment to make sure we were not rewarding people that were not driving the objectives, financial objectives we wanted to meet. Organizational development, putting the right people in the right positions and empowering them to make decisions. So you as an owner, you can go on vacation and not have to worry about things. You always kind of have to ask yourself as a business owner, are you more an intangible asset that the things you do and put in place increase the value of your company? Or are you what we call in accounting an off-balance sheet liability, a liability on the company that does not show on the balance sheet? For example, I was advising a owner a few years ago. I had a great technology at his company, and technology was needed in many large markets. And the owner had just good technically, but just didn't have the business acumen, didn't delegate, wouldn't hire qualified managers. So the business just generated a little revenue. That's an example of being kind of an off balance sheet liability for the company. And then last but least, they established a well-rounded advisory board or team to spring ideas against and get advice against. And obviously, it makes a lot of sense to engage business brokers, M&A, and exit planning advisors like VisionOne early in the process to help make sure you check all the boxes. And two areas that I want to concentrate on is the accounting professionals and the legal professionals. Accounting is a broad range of skills. There's general accounting, there's cost accounting, there's cost management, there's financial analysis, there's business partnering, there's pricing. And so it's difficult to be good at all of those. CFO type roles are generalists, and they know a lot about all of those, but they bring other people in for help. We find that many small companies, the main advisor is their CPA. Mm-hmm. Mm-hmm. And some of them are pretty good at some of the other things, and many of them are not. So you got to make sure when you're analyzing your business and pricing your business and making decisions, you get the right people. Yeah. In the Fortune 100 companies I worked with, we always separated the accounting organization. We had the general accounting organization that dealt with GAAP accounting and making sure we were in compliance with all the SEC reporting. But we had a separate side of accounting that partnered with the business leaders and did the financial analysis, the planning, the forecasting, and all those things. So keep that in mind. And the other thing too is when you get ready for a transaction, make sure you use a deal attorney that recognizes it's important to get the deal done and want to eliminate a risk, but you can't eliminate all risk. We don't live in a risk-free society, and the attorney last week talked about that. as well. That's important because you'll end up spending on both sides 30,000, 50,000 in legal fees if you try to get to a totally risk-free free deal. So.
Well, and Ray, I really appreciate you talking about the different kinds of advisors, because your advisory team, as you work on your transition, it is different. It is different than perhaps your regular board of trusted business advisors, because you do want to bring people on board alongside you that understand the transition process. And people will come in and out of that team. That deal attorney may not be someone that's with you all the time, because you have an attorney that is well versed in your general business practices. And like Ray was talking about, your accountant as well. You'll have your general CPA perhaps, but then you'll have one that does have an eye and looks at bringing in to the whole picture all the elements of a transition plan: personal, business, and financial. And, and it's interesting because we have a pie chart of how we like to look at all the different forces, if you will, that will affect your transition. There's a lot of different forces out there, and some of them you can control. And Ray was touching on them briefly, and he'll go into more detail on them in a little bit, because those are the ones that you can impact. That can help you with that multiple that gives you that value, that price. But there are forces out there that you can't control. There's the external forces, whether it's political, economic, societal. You look at today, you look at the pandemic today and the impact it has had on your business and on so many businesses, and the ripple effect it will continue to have. Those are things that you can't control, but you need to be aware of them. And same with a lot of the market forces, the market timing. I mean, I have colleagues that since I sold my business in May of 2019, and the trophy business is the event business. So needless to say, it's been obliterated with what's going on with no events happening, no sports happening. There are colleagues that say, oh, you had such great timing. Well, I didn't time the market. I got myself ready, I got the business ready, and was able to strike when the iron was hot. But if you try to time the market, that's a hard thing to do. So when you look at the different forces that will affect your transition, and when you listen and learn from Ray as he goes forward, really focusing in on those business forces and the things that you as a business owner can impact.
Okay.
And Ray, I love this slide about how a small company is a risky financial asset.
Yes. Thank you. As Lori just said, a small company is a risky financial asset. It's subject to, just like other companies, subject to business cycle changes, ups and downs of the business cycle, intense competition as markets mature, changes in laws and regulations, and business value migrates to business designs. So like technology. So as you can see now, based on the pandemic, a lot of businesses are going more virtual, and many may stay like that. So that's going to be a different way, different design, and way customers want to receive their service. United Health here locally, they've got a pretty large virtual workforce, and they make it work well. So from a planning standpoint, as we talked about, if you look out 5 years, you kind of got to see how your business fits into that and what adjustments that you need to make to stay competitive. Or if you don't feel you want to be around that long to make that investment, then maybe it might be a time to transition the company. So keep that in mind. The reason that a small company is a risky asset is lack of liquidity. it can take up to 12 months or longer to sell your company when you get ready. And the reason it takes a long time is that because the lack of analyst coverage, people don't know who you are, because analysts aren't explaining it to you every day, every week, and so they don't know who you are. There's no SEC financial reporting requirements, so your financial statements are foreign to any particular investors. So they would have to do due diligence and so forth. So when we take on an assignment to sell a company, and the reason it takes so long, we have to introduce your company to the market, and that's about that could be about a 9 month process. First we've got to get your financials, analyze them, and those type of things, make sure they make sense. But it makes sense. Also put together a marketing package and profile that oftentimes we have to develop from scratch. Versus if there's a business plan already put together, or that you could streamline both of those. But just the preparation to go to markets could be about 45 days or 6 weeks. And then actually marketing to potential buyers that we have identified and get them interested and so forth. That might be another 60 days. And then meeting and negotiating with you and introducing them to you. That could take another 60. Agree on everything and do due diligence for another 60 days, and then another 45 days to close. Now that's why it takes 9 to 12 months. But we've sold businesses in 30 days or 2 months. But that depends a lot on the size and how good your financial records are, and how good if you got a business plan in place and understand your market. Second, there's no why it's a risky business. There's no minority interest market. So like in the stock market, if you want to dump your stock, you can sell it in 15 minutes. In this business, there's selling minority interest is just not a big market for that. So it could take 9 to 12 months. And so if your business turns down, you're kind of in it for the long run. And the last point is point in time valuations. Point in time valuation, if your market if your financial performance drops, there's normally an immediate impact on the valuation. So that's something to remember. With COVID, though, we've been able to convince most people to treat that COVID as an add back. In other words, we take it out of the financials as a non-recurring event. So we've been able to work around that.
So you've been able to, or have found potential buyers open to the idea of not taking 2020 completely out of the mix, but discounting the effect, discounting the drops in revenue and things like that?
Yes, we can do that. But the key to that, though, is they've got to be convinced that you can recover once you come back.
Okay.
So if you look at the period the year before, you can kind of say, okay, that's what it would look like without COVID, or the trends that were in place before it dropped.
Sure.
And then you can rationalize if next year if that's going to come back. So.
Okay, that's great.
Yeah.
Talk a little bit about those private capital markets. How does that work?
Yeah. Private capital markets is the market, and it's not as well developed as the public market that most of us are familiar with, but it's coming more well defined. And this capital market mechanism really determines how businesses are valued and transferred. And it's best explained in a triangle diagram. The valuation is at the base of the model, and it is based on the economic benefit stream from the business. That's kind of the free cash flow, cash profit. and then it gets input from two sides of the triangle. One is the transfer method. So if you're transferring your business via ESOP or transferring to family or trust, insiders or third parties, there's different valuation methods. The one that we're focusing on today is more transition your business to a third party.
Okay.
And how this works then, if from a capitalization standpoint, that's financing, and that what that says is what return does an investor need to, based on the risk associated with the company, need to buy your company to get that economic business stream. And in the middle market or Main Street, that is defined as a multiple. For example, Main Street businesses generally sell between a multiple of 1.5 to 4. Okay, the lower the multiple, the more risky the business. So a 1.5 multiple is about a 67% return they're going to need on that, and that would apply to mostly to a business that is primarily owner centric, like a one-person CPA firm. Obviously, that if that business sold, it would sell at very low multiple. The higher end would be using a 4 in Main Street, and it gets higher as you get higher up to the middle market. 4 is about a 25% return they're expecting, and that applies primarily to companies that have like a product manufacturing company that has a proprietary product, has strong investment in capital equipment, and so forth, tend to be 4, and everybody else is in between. Service businesses are generally under around 2.5 to 3.
So do you find business owner, and you mentioned you're the one client who she thought her business was valued at this, and in reality it was valued at this. You know, are there different, I mean, do you find that there's lots of different kinds of valuations for the same business?
Actually, there is, and I think we've got is that on the next slide there, Lori?
I think so.
Not Lori, Brittany, yes. Yes, absolutely. You know, the valuation depends on what value world you're in. Value world meaning defines in terms of you know, what you're using the valuation for.
Okay.
So you can see in this chart, for the same business, there's 9 different valuations, ranging from about 2.4 million to 16.6. And so just imagine you're thinking your business is worth 15.8 million and it's really worth 2.4. That could be devastating. And we already talked about the lady that thought her business was worth 3.5 million was really 600. So it depends on your value range. On the positive side, I recently completed a broker's price opinion for a client. That's our broker's price opinion is what we call the brokers call evaluation. To look at a business he was thinking about gifting to his family member for about 2.5 million, based on some fair market value valuation that's really involved in gift tax avoidance.
Sure.
The BPO, in terms if you took the business to the market, came out to be about $7 million. So in other words, if we took this business to market, our market price would be $7 million. And so this owner has some choices of what to do. Should I just gift it to a family member and get a little bit of money, or do I sell and take money off the table and buy another business? But so there you can see that value range can be very significant and is important as an owner, that you know where your valuation is, depending on what you want to do when you transition.
Got it.
Okay.
Mm-hmm.
Next slide. Another thing in terms of planning as a seller, you want to understand the different buyer categories and develop your plans in your business to attract those types of buyers. Okay, so what this chart shows is that the buyers that are closer to you, like employees and competitors, tend to pay the least. Competitors, you would think, would pay more because of scale and taking a competitor off the field. But a lot of competitors in the small business areas aren't looking at this strategically. And employees, and I think Laura, you probably can talk to this, is employees tend the owners tend to give employees a little break on the sales price.
You know, and you're right. When I think back to selling my business, you know, I'd had evaluation done, and that's what we were working from. And then because he was working with a SBA preferred lender in financing it with the SBA, they had to do their own valuation. And that valuation came in higher than what the selling price was. But that, you know, that does also get back to, you know, your motivations or, you know, the legacy, the idea that you have also for the transition of your business. You know, I knew I left some money on the table by selling it to him, but I also knew the vision, what I had put into it for the 16 years I owned it would continue, as well as the staff. So, I mean, those were things that went into my being okay with that. And plus, you know, I knew my numbers, I knew the net proceeds, and it worked, you know, it met my goals. So because I had that knowledge and that plan, I think that's probably also why it was comfortable for me to have it happen that way, you know, to have it be somebody closer to me in your circle versus looking further out.
Now, another group that pays quite a bit are private equity groups. They pay. They'll pay if the financials line up. They're pretty much financial buyers, and so if the numbers check out, they'll pay well. The only downside with private equity groups, they look at a lot of deals and only close on a few of them. But if you're one of the lucky ones, they tend to pay well. Strategic buyers tend to pay the most. You know, strategic buyers understand that they may have a hole in their product line they want to fill. They may want to create more scale. They got excess capacity, and they may have a different cost of capital structure that allows them to pay more than people that's in the market. So in turn, go ahead, Lori.
So with your with Sunbelt and the tools that you have, are you then accessing, because you work on the buy and the sell side, if I'm a client of yours and I have a business to sell, do you work with all these different kinds of buyers? Are you able to introduce my company to these different kinds of potential buyers?
Yes, absolutely. So, yeah, we have an extensive marketing process. You know, like I said, we've been in this market for almost 20 years. So we have about 40,000 buyers in our system, and about 35% of them are active. And so every listing we get or engagement we get gets exposed to that market. So we don't have a publicly traded stock market, but that's about as close as you can get to that in the Main Street small business market. We also do on the larger deals we work on. We do it a little bit different. We actually target specific buyers, specific companies. We have tons of databases and also people in our system, and we can identify likely strategic buyers, likely private equity groups for your business. And in these type of deals, when we're trying to go after a strategic buyer or a private equity group, we generally go to the market without a price. And the reason we do that is because these companies may have higher cost of capital numbers, and they may be able to pay more than your normal buyer. So we let the market drive the price, and then we try to create a private auction, sort of a bidding war, to get the price up.
So I mean, that to me makes so much sense on how, as a business owner, having somebody with your skills and abilities walking alongside me, I can be focused on working on my business while you're helping me with that end of my transition plan. Because if you think about it, it starts with the profitability, of course, of the company. But you mentioned this as well. It's also about what's sort of, under the covers. It's not just the profitability, but what are those profitability? What do they represent? How high quality are they? You talked about the idea of buying equipment, close to the end of the transition, and does that really make sense? Making sure things are aligned so you can keep your value up. Because when you think about it, when you look at how most private companies, can increase their value, and this next slide sort of walks us through it a little bit, is being able to work, you mentioned that Main Street multiple range of being 1 to 4. So it's about, well, I want to get closer to that higher end, and what can I be doing? And with the assistance of somebody with your skills and background, I can have that plan in place to get to that higher end of the multiple. Because this next slide really, I mean, when you look at, if you were looking at this slide at company A and company B, and you were talking about this earlier, Ray, I mean, when you look at the top, just at the top level, both of these companies look sort of the same. They're both 25 years old. They have niche consumers, so they know who they focus in on. Their sales are similar, the same. Their EBITDA is the same. And if that EBITDA goes, that multiple goes against their EBITDA, you would think that multiple, then that price would be the same. They both have manageable nominal growth rate. But then when you start looking deeper into some of the things that you had mentioned, that's where you see the difference. You have a management team of one that there isn't one. You have one that's very experienced. Like you were saying, you have strategic planning in place on company B. So they're deploying it, they're working from a plan. So that, as you mentioned, totally would lower their risk factors. You have systems in place and processes. And you have stakeholders that are, strategic partners. So when you look at company A and company B, with what you were sharing, Ray, that multiple range, you can get to that higher multiple, can't you?
Absolutely. Absolutely.
Well, and that's what's so interesting, because for your Main Street businesses, for the small businesses, so much of that value of that company is tied into those intangible assets, as you were mentioning. And that's what truly can differentiate you.
Absolutely.
And help you get that higher end of the range.
Yeah, to give you an example on that, I recently sold a specialty construction company who lined up very well with all these things, the intangibles, had good reviewed financial statements, had outlined their growth strategy and where they needed to grow. Been in business for several years, so they got a good history. So due diligence went pretty easily, and we were able to sell that company. And this is not a norm. This is unusual. We were able to sell that company at about 2 times revenue and about a seven multiple of EBITDA. And this wasn't a very big company, but but it showed so well, and the strategic buyers that bought it saw they could really grow it. So you're absolutely right. These intangibles make a big difference.
So tell us a little bit about the tool that you're offering to our attendees.
Yes. One, we love talking to sellers and helping them understand the market and how their company fits in that. We do offer a free value range analysis for your company, where we look at your company and the niche they're in and the intangibles that you have in place or do not have in place, and kind of assess if we took your company to market, where we would price it at. And that's good to have that, because that allows you, maybe it meets your goals and you're comfortable with that. But if you want to move up and to a higher price bracket, it's good to understand that value, so you're not shocked at the end. And also, you can actually, we talk to sellers and actually buyers all day long. So I certainly welcome a call if you got questions to talk through some of this as well.
Sure. Wow, that's terrific, because as a business owner, you're so close to your business. It's your baby, and you think you're sure it's worth a lot, and it is to you. But this is a nice tool to then get a feel for, okay, I know it's the world to me, but what's it look like out there?
Absolutely.
I love to hear you talk about the different kinds of financials that benefit stream that you mentioned earlier. How does that work?
Sure. There's I hope people can read this, but there's two primary economic benefit streams that's used in this market. And the first is what we call EBITDA. Some people say EBITDA. That's earnings before interest, taxes, depreciation, and amortization. This one is widely used in the middle market space by financial and strategic buyers. It provides a good way to compare your business performance, as it eliminates the impact of seller's financing, income tax strategy, because each company has their own strategy. It adds back expenses that are not a current outlay of cash, such as depreciation. Add back excessive owner benefits and one-time recurring charges. And this methodology is generally used when EBITDA is at least $1 million. And so this is when we say recast your financial statements. This is what it is. We'll take your net profit, either from your tax returns or your internal P&Ls, whatever works best. If you go to the banks like your tax returns, but we'll start with that, and we call that recasting your financial statements to a cash flow basis that shows the new owner what they can expect to receive in terms of return after all necessary business expenses are paid. And that number is, we apply a multiple to that number to come up with a price. It's pretty much how that works. And that number, that multiple, again, that has a lot to do with some of those intangibles we talked about earlier. And in the 1 million EBITDA and above, these multiples can go, I like to say it ranges 4 to 6, but it can go a lot higher than that as well. SDE is the second one, and that's primarily used for the lower, the Main Street sellers, that have EBITDA less than $1 million. It assumes that the owner will be owner operated, and so the owner's income is included the owner's salaries and benefits are included in income. And so that's a difference. So oftentimes when buyers come in, we have to educate them because sometimes we have large buyers and used to using EBITDA want to buy a business, a Main Street business, and want to price it on EBITDA, and that doesn't work. So there's another thing too when it's priced on EBITDA, the strategic buyers, the private equity groups, they're going to want your working capital as part of the price. So and versus on the sell discretionary earnings, they'll have to SDE. The Main Street buyers typically pay for your inventory, you keep your receivables and so forth.
Mm-hmm, mm-hmm. Well, and that again gets back to the idea of using advisors that are understanding the transition process, because, you know, I know as a CPA and as a business owner, I'm wanting to lower my tax bill always, get it as low as possible. And when you're wanting to sell your business, you want those financials, that economic stream to show how much cash is available. And that's a difference. That's a different way of looking. How's the business doing?
Absolutely, absolutely.
And
Yeah.
this is interesting, your chart on the impact on value. When you look at, you know, the adjusted EBITDA and the difference it can make on where you fall in the multiplier range.
Yes, absolutely. So this is an interesting chart, and we call it kind of a two-step value improvement process. As we talked, most companies fit into a certain value range based on your size, your industry, and so forth. So, for example, in this example, the multiplier we used was 4, and that would be the high end of the range, and the range could be 3 to 4. And you can see in this example, by working on a lot of these intangibles, you can get your multiple up to the high end of the range. And so with an EBITDA of about 1.5 million times 4, that's about a $6 million price. Okay, so that's good. But what we find though, I'm sorry, 4. But if you improve the value range I should be talking about is 4 to 5. But if you improved on some of those intangibles, we may be able to get a price based on a 5 multiple, and that's gives you about $7.5 million. So that's about $1.5 million improvement in cash you would get at closing.
Got it.
Now, the big part of this, though, the big dollars is if you're trading in the 5 multiple range, for every dollar improvement in your economic benefit stream, being EBITDA or SDE, that's worth $5.
Mm-hmm.
So if you improve your EBITDA by $1 million, stayed in the same multiple range,
Mm-hmm.
you're talking about a $12.5 million valuation versus the $6 million that we talked about. And so that's something that I find a lot of sellers don't necessarily spend a lot of time on. But those are big dollars there. To give you another example, I know we have put together a consortium of, not consortium, I guess you can call that, of insurance companies where they're willing to offer a lower price for some of your insurance. And I know insurance, liability insurance and all those things are big in companies. But because of the volume they'll be able to get by working through us, they're willing to offer some significant discounts in insurance premiums. So that's another thing you can certainly call me or our office about and see how to participate in that. So if you're at a 5 multiple and you improve your insurance by, you know, 50,000, that's real addition to the bottom line in terms of pricing your business.
And your chart here sort of makes the case for the idea, the thought that making transition planning part of your business strategy and bringing it into the present tense, you know, it's a math equation. I mean, as a business owner, if you've made value enhancements like you're mentioning, and that's driving your EBITDA up, you as a business owner get to enjoy that benefit now. So, right. You know, plus, even if, you know, it keeps your multiple the same, but you've increased your EBITDA, that right there provides you as a business owner growth as well.
Absolutely. Absolutely. And the thing to know, you know, over the years, I have participated in about 50 profit improvement, business enhancement initiatives throughout the U.S., Europe, Asia, South America, and big and small companies, all types of companies. And I can honestly say, when you focus on that, you always find significant opportunities to increase your value.
Sure, sure. Got it. So walk us through again some of the value drivers and deflators, because, you know, this chart really drives it home how and why somebody should work on their value drivers. And actually, I think I skipped ahead a little bit, just looking at time and wanting Ray to have the time to really talk about value drivers and deflators, because that makes such a big difference on the math.
Sure. Okay. Yeah, so this is a generic chart of value drivers, and you can see from the diagram at the top what things drive value up. And so, if you're in a growing industry and have proprietary products, that's good. You can generate a lot of interest in a higher multiple. If you have high barriers to entry, where it's difficult to get into your industry because of the capital investment, or maybe because of the customer relationships, or those types of things, and if you have a strong brand name, that's positive, because it's hard for competitors to get in. So that helps you from a valuation standpoint. If you have intellectual property and customer diversity, that helps a lot too with your business. So if you have intellectual property that gives you into a market that can generate a lot of potential revenue, a lot of strategic buyers would be interested in that, because they may have a bigger platform to drive their technology. Customer diversity, that's one of the first questions asked or looked at by all buyers. What's your top 3 customers? What percent of revenue is that? So they kind of all read the same book. So that's the first question they're going to ask. So think about that, because customer diversity is a real risk. You know, not too long ago, I had a nice service company that primarily worked for one Fortune 500 company, but it was like 20, 30 different locations. But that one company, that Fortune 100 company, made up about 95, 96% of their revenue. It was a very profitable company, but people here to take that on. Another example of this customer diversity thing. Now, I don't want to say all customer diversity is not customer diversity. Customer concentration. I'm sorry, I went off on the wrong tangent there. Not all customer concentration is bad. When I worked for Honeywell's defense system business, all of their business was with the government defense department. But the contracts they had were all the year over munitions and projects that were not going to go away. So that's not bad. That's not bad. In the I talked about management, management in place to take over when you leave, so you're not dependent on just the owner. That also drives your price up. But on the other side of it, if you have a commodity product that anybody can produce, that's not going to drive a high multiple. I talked about if you got customer concentration, 1 to 3 customers make up the bulk of your business, that's going to be a value inflator. And again, the owner-centric initiative will drive your value down too.
Mm-hmm. Mm-hmm. Got it. And you can see where those are things that as a business owner, being aware of them, being able to answer that question, what do your top three customers represent in your revenue and your product line, understanding that, then you can be driving the bus on your business, on where it's going versus just waiting and hoping for the best.
That is true. Maybe we can go back to the other chart if we got time. That was the maximizing value.
Mm-hmm.
5 keys to eliminating cash drain. Yeah. There you go. I just want to talk to some of these things briefly. One, net working capital. Yeah, they call it working capital, but it doesn't work for you. There's a lot of companies that's going out of business because they're profitable, but they got so much working capital they can't meet their expenses. So it's kind of a drain, and it hurts you when you sell your business because, as I said, these strategic buyers, in their price when they offer that 5 multiple, 6 multiple, or whatever, they expect to get your working capital. So they get your AR, inventory, and they'll pay the accounts payables. But if you got net working capital of say $1 million, that's included in their price when they offer a multiple of 6. So that, to me, it's a cash drain because one, that's $1 million you've got sitting there in your operation that you can't invest anywhere else. You can take that $1 million and buy another business with $1 million cash flow. So that's a cash drain that people don't think about. The other side of that, it can make the deal financing tough. I'm working with a distribution company right now and then trying to get the SBA financing together because their inventory is about almost 50% of their revenue. It makes it difficult to get the financing in place, and it makes the multiple look upside down. So you want to kind of maximize, you want to minimize your net working capitals, and there's ways to do that. Mm-hmm. The second funny chart that shows a line going up and then coming back down called profit contribution by SKU. Mm-hmm. Because of many companies, and this is where we get into trying to use the certified accounting records to manage the business. And so in generally accepted accounting principles, generally there's an averaging process to determine cost by product, so they can move inventory through the facility pretty easily. But if you try to use that to determine your pricing and your marketing strategies, you can run into problems. So what this chart shows is that about 20% of this company's total profit it comes 100%. Another way, 20% of the company's product they maximize out on their profit, and the other 1,000 or so SKUs won't add a dime to the operation. So that's a cash drain, and you need to figure out how to fix it. We already talked about performance measures being a good way to make sure all the important organizations and people in the organization are aligned. The other is working capital, outsourcing. It is, if you're totally vertically integrated and you're outsourcing your vertically integrated, and you're not outsourcing some of these small parts that are not really important to the overall product, you're probably spending more money. You probably can get that cheaper by buying it outside.
Got it.
And the last one I wanted to cover, the one called process reengineering. Mm-hmm. worked with a large claims processing organization years ago, and they spent about $33 million to move a claim from a medical office to process payment. It cost them about $33 million because they had such a manual process versus technology. By moving that, implementing the right technology, they could actually take that claim right into the processing system and reduce the bulk of that cost. But those are some ideals when you start looking at increasing your value. Those are some areas you can look at in terms of improving the bottom line. But there's also ways to increase your sales too that I'm not covering in this presentation, but you can also grow top line as well.
Absolutely.
Okay.
So the idea of growing through strategic acquisition.
Yes. I think this is the best way to grow.
Okay.
Obviously, my opinion is low bias because I'm in the industry. So what that first side of the chart shows is a company that has some good steady growth, organic growth that they expect over the next 3 or 4 years. But by making a strategic acquisition, they can change that the arc a lot higher and still grow from. Strategic acquisition is one that is accretive to the value of your company. Okay, so it adds value, doesn't distract, doesn't bring a lot of cost with it. So it's all upside.
Got it.
The debt serviced by the profit is serviced. The debt is serviced by the profit created by the new acquisition. So you don't necessarily have to drain your current cash to make this work. Debt cleared, I say 12, 18 months, but say 24 months, 2 years. 2-year payback is a pretty good investment. Benefits are several. It can reduce competition, gain more market share, better economies of scale. If you got excess capacity that you can add these things in, it's just gonna give you more scalability. Achieve some more strategic alliances within your organization, and greater leverage with suppliers. A big cost of a lot of people is their suppliers, and if you can consolidate some of your competitors and create a buying group, you can reduce your cost of materials. So I think the acquisition is a good one, especially if you reduce your working capital by, I'm gonna go back there. Reduce your working capital by $500,000 or $1 million. You certainly can make one of these strategic acquisitions that will be good for you.
Well, and it's funny because that's where this whole idea of planning your transition is a moving process. Because as you're putting things in place, value enhancement tools in place, you might be energized and realize I want to keep growing. I'm not ready to sell yet. And by working on it and having it be present tense, you might be open to a strategic acquisition that you weren't earlier because you weren't realizing how to do it or how to keep increasing the value of your company and enjoying those benefits before you transition.
Absolutely.
So talk to us a little bit about the cash flow, maximizing your value, or this case study.
Yeah, sure. What you see there is this is a process we use with strategic buyers.
Okay.
So, not buyers, with sellers that want to attract private equity groups and strategic buyers. And so generally these are companies with at least $1 million in EBITDA or above.
Okay.
So we do kind of a different process. We go through what we call an auction process. And so we, in this particular example, we don't do them all of them. We went after several. We sent the teaser or the confidential targeted advertising to quite a few buyers, potential buyers. And we asked them to come back with a letter of interest. The one well, they'll sign a NDA and a confidentiality, and and they fill out other stuff, and we'll look at them a little closely and decide if we want to share the confidential profile or the confidential information memorandum. See them with if and if so, we'll send it out to them and we'll talk it through with them and get them understanding. If they're promising, we may arrange a meeting with the seller, with you, the seller, to see if you're comfortable with them. And then we'll ask back for letters of interest. And you see the example, several people came back with letter of interest. And then we narrowed it down to 5. And told them to come back with their letter of intents and their best offers. And you can see there's a wide range of offers. This is important. So this is important. Like I told you before, if you line up really well against all those value drivers, drive a lot of interest, and you may be able to get higher than market price for your business. So in the green shows what their first offer were. And so we went back and said, okay, we got several people competing. Come back with your best and final. And you see the one on the left there went very high, and that's where we sold. So that's pretty much the process we use for companies that could attract the strategic and the private equity buyers.
Sure. Got it. So it really gets back to making sure, and we touch on this on what is our slide 34, is having your business be ready. So then you can answer that question, are you ready to sell and transition or stay and grow? Because with the work that you're doing on your business, you may want to stay and keep growing so you can move the value forward.
Absolutely.
And there are steps, and Ray was mentioning this, and he talked about due diligence. Go back to that one right before, or a couple ahead, Brittany, number 35, as far as getting your house in order, your business house in order. You know, there are some things that you as a business owner, along with your advisors, that you want to have in order. You want to have completed and ready. You want to have those standard operating procedures documented. That was something that Ray mentioned as far as having having that value driver, having that documented, having your financials in order. When Ray walked us through the recasting of the financials, that's critical. So you're really ready to go, and you have your checklist completed. So you've got sort of a playbook. And I'm sure, Ray, you work with your business owners on that, on getting everything ready so you can go to market. Sort of the buyer has to do their own due diligence, before, or not the buyer, the owner has to do their own due diligence and really get their house in order before you can present it to potential buyers.
Absolutely. That's so like working with folks like VisionOne, and point that out early, where you got all your financial information in order. You've got your business plan in order that pretty much spells out the things we're going to use for the marketing materials. You're tracking well against your business plan. That's going to give you a higher valuation, and it's going to lead to a quicker sale as well. So.
Absolutely. Well, and as we move into wrapping up, please, if you have questions, put them in the chat box. But Brittany mentioned it at the beginning, that we have a number of tools that we want you to be able to walk away with. And one of them that we're coming forward with for VisionOne is the opportunity for you to take an assessment to see if you as an owner, if you're ready to exit. What's your personal readiness to exit? Because, we talk a lot about getting the business ready, but we also want to make sure that you're ready and that you have a plan so you don't regret exiting your business. And so the tool that we have is called a pre-score. It's a personal readiness to exit score. It's a short assessment that looks at some of the different drivers for you to have a life outside of being a business owner, and where are you at on that. So you will receive the link to be able to get that and the follow-up information. We urge you to take it because it's a journey. It's getting yourself ready, your business ready, and being able to be successful. So that's what we at VisionOne would like to offer. The other thing we'd like to offer is from our bank, Highland Bank, Melissa Johnston, who spoke the very first week on the importance of having a relationship with your commercial banker. And oftentimes we don't know who our commercial banker is. And so she wanted to offer time, whether you're a customer of Highland Bank or not, to get together with her and learn about the importance of having a relationship with your commercial banker and how they can walk alongside you, not only during the transition, but leading up to it. So you'll receive the information from Highland. The community development folks, you know, we'll get you their contact information. They really want to be able to match you, because when you, as a business owner, are transitioning out of the business, that makes a difference in your community. And there are tools and resources available to you through the Community Venture Network, through a lot of your economic development folks, to make sure that that legacy, that impact is a positive impact. Last week then, we had Josh talk to us about the importance of having the right legal partner on that transition. There's a checklist that will come to you from him on some considerations on things you want to ask on gauging if your business is ready. So you get yourself ready, you get your business ready. And again, Josh is available for a 30-minute conversation to be able to answer some questions, to be sure that your business is ready. And then today we had Ray bring forward the no cost value range analysis. And that's just tremendous. You can find out where is your company currently at. And then with the help of your advisors, be able to get that business ready so you can increase the value. So we really hope that you take advantage of these offers, because that's what we want to be able to provide to you, are tools and resources as you walk through the process of planning your transition. Our goal is that you bring transition planning into the present tense. It's not something you wait to do. You work on it now. It simply becomes part of your business strategy, because every decision you make today will affect your end, your transition. And so the more you can be having it part of the backbone of your business, that you're always working on your business, so you can increase the value of it, so you can be ready. So when you are wanting to transition, you will have the best opportunity for success of getting that transition across the finish line. Because we looked at the chart earlier, and Ray, I'm sure you have examples, and we all have examples of owners that thought they were ready to transition, but they couldn't get it across the finish line because the house wasn't in order. Their business house wasn't in order, and maybe they personally weren't in order. And that's what your team of advisors wants you to be able to do, is to cross that finish line of that transition successfully.
Absolutely. And next week, we are going to be joined with our CPA, correct, Lori?
Yes, that's correct. Yep.
Yes. So you'll also be receiving a link today through your email that's going to include a recording of today's session. I know a couple of you have reached out asking for that. Links to all of the partners that Lori mentioned just a moment ago. And we would love for you to join us again next week. We have 2 weeks left in this series. We really believe that next week with a CPA, who is going to kind of tell us the pitfalls of what not to do. And then the week after that with a wealth manager.
So thank you, Ray. Thank you so much for sharing your time and your knowledge and the value of having somebody from your background walk alongside a business owner and sit at their table of their transition team. Because again, as business owners, you're experts in running your business. So bring other experts along that are knowledgeable in transition planning so they can assist you. So you can be successful in that transition and maximize those net proceeds.
Thanks for the opportunity.
Thanks, Ray. It was great to have you on board, and look for Brittany's follow-up. Take advantage of the free tools, and definitely join us for next week as we build on this building of your team on these steps.
Perfect. Thank you, everyone.
Thank you.
Bye.